Hello, everybody, and welcome back to Open Interest. I'm Mike Coe. For those that look forward to these short web extra segments and have been missing them for the past 2 weeks, forgive the programming interruption. If you look behind me, you may notice the background has changed, and that's because I've switched offices as some pandemic policies relaxed. Hopefully, we'll be able to return to producing content more regularly. After a modest bounce yesterday following last week's declines, equities, after opening higher, fell again today, actually dropping below Friday's closing levels. This followed comments by Fed Governor Lael Brainerd that the task of curbing inflation is paramount and that the central bank may begin to reduce the balance sheet as soon as next month. Whether or not the central bank will have the fortitude to do what it takes and possibly resist the pressures another taper tantrum might impose remains to be seen, but oil fell and the dollar strengthened. The prospect of rising rates may have prompted some of the largest listed options trades we saw today. ARK, Cathy Wood's Innovator ETF, which is up roughly 27% since the recent March lows, saw a large bearish bet, with a trader paying about $1.75 for 20,000 May 60/50 put spreads. That's an outlay of $3.5 million in premium on a bet that ARK's recent rally may just be a dead cat bounce, targeting a move of about 12 to 25% to the downside. Another ETF that has seen good-sized bounce since early March is EZU. This ETF tracks the performance of publicly traded companies listed within the European Monetary Union. Here, we saw an outlay of over $1 million in premium on a bearish bet that EZU, which closed just under $43, will fall below $40 by May expiration. HYG, the high-yield bond ETF whose recovery was only about 2% off the March lows as of today's close, is targeting for further weakness by an options trader who purchased over 44,000 of the May 81.79 put spreads, risking over $2.2 million in premium on a bet that HYG will retest the March lows by the third week of May. Finally, possibly in the belief that rising rates could elevate financials, we saw a purchase of 73,000 XLF April 29th weekly 40.5 strike calls for 6 cents. And while the contract quantity representing 7.3 million shares of XLF seems impressive, this trade is risking a more modest amount than the 3 bearish trades we've already discussed, about 440,000 in premium. This is a low premium and low probability bet that XLF could see a short-term bounce, and these options expire 3 weeks from Friday. That bullish bet wasn't really representative of the day's activity in the options markets overall, though. Across all single stocks, ETFs, and indices, options traders got net shorter today overall by about $6.5 billion deltas, a stark reversal from yesterday's net bullish activity where options traders got net longer by just over $8 billion deltas. If you enjoy this kind of content, please like, subscribe, and hit the notification bell. And if you have a comment or a question, please share it with us. We may just respond. I'm Mike Coe. Thanks for watching. If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/Open Interest. And of course, you can also follow or tweet me at Michael_Coe or go to our website, www.openinterest.pro. Thanks for watching.